Welcome to the Mental Health Market Update, where we talk about what's happening in the mental health industry. Here's your host, Stephen Hayes.
Welcome back to another episode of the Stigma Podcast. I'm your host, Stephen Hayes, and I'm excited to be back with you after a brief break around the holiday season at the end of 2020. This episode is our first mental health market update segment of 2021, and we're going to cover a few specific things that include, number one, mental health startup valuation trends, number two, mental health startup investing trends, and number three, 9 key takeaways from the mental health market in 2020 as we head into 2021. Every week, I hear from a venture capital fund, a family office, or some other investor who's about to make their first investment in a mental health startup. They ask some basic industry questions usually, which often vary, but they always end up asking one set of common questions around valuation. They want to know, what is a fair valuation? What are fair funding terms? What's competitive in this market? On the other hand, I hear from founders regularly who are asking the same questions about valuations, terms, round structures, etc., so they can go back to their potential investors and be well positioned to negotiate based on what's going on in the market. So I wanted to put together some thoughts that could help both investors and founders level set their valuation and pricing conversations when negotiating a funding round in the mental health startup space. As a former investment banker, it's still ingrained in me that when the valuation conversation starts, my first reaction is to ask, what are the comps? For those not familiar with the term comps, I'm referring to comparable companies. One of the ways that we value companies is on a relative basis to similar companies. That doesn't always mean that those companies that we compare our businesses to make the same product or are even in the same industry. We look for companies with similar customers, similar vendors, similar growth and margins, corporate finance benchmarks such as leverage, and so on. Usually, comps are in the same industry and do have a lot of similarities. When we talk about startups, we have to bend the rules a little bit to find comps. If you're building a SaaS startup or an automobile company, you're going to find a handful of existing excellent comps to use as a benchmark. However, in the nascent mental health startup market, you're just not going to find a pure play mental health public company with the same growth and margin profile as a startup to benchmark valuation against. It would be nice if there were a dozen or so public mental health companies that had large market caps, robust equity coverage, etc., so we could track their trading levels and their estimates to extrapolate insights for the purposes of figuring out if a private market deal is overpriced or not. But if that were the case, we would have missed the boat on investing in a nascent early stage market with incredible fundamentals like what we are seeing in the mental health space right now. I want to start with the public comparable companies we track and then reference check where they trade against some of the private market rounds we've seen in the last couple of months to sanity check what's going on in the mental health startup market. So, who are these public comps? About a year ago, we put together what we called the Disruptive Healthcare Comp Set, which included 6 companies. Today, that list has changed drastically as Livongo's been acquired, and COVID has totally changed the market, while several companies have gone public in the last year that are relevant to what we were doing as well. We've selected the digital healthcare service companies for our comp set that in one way or another look the most like mental health startups that we are funding in the private markets. We look for companies that are selling healthcare services, usually mostly digital, to patients where the service is paid for sometimes by the patient and sometimes by one of the payers in the market. We also looked at which companies are growing fast, like a startup, and still have a lot of room to run in an evolving market. The result is a digital healthcare services comp set that includes, and these companies are sorted by their market cap from largest to smallest, Teladoc, GoodRx, Oak Street Health, Amwell, One Medical, Health Equity, Progeny, Accolade, Phreesia, Health Catalyst, and OnTrack, which is formerly Cadasys. We also keep an eye on what we call the other relevant healthcare and behavioral health peers, but we put them in a separate bucket because they're larger, they're later stage, they're mature companies with very different growth and margin profiles than the ones I just mentioned. Those companies are HCA, Universal Health Services, and Acadia Healthcare. Since a lot of these digital healthcare services comps are hyper-focused on top-line growth and not so much on EBITDA or earnings per share, they do look a lot more like a startup than a larger, more established healthcare provider. Think HCA, UHS, or Acadia, which we just mentioned. Because of this, we lean heavily on their enterprise value to sales multiples, and we pretty much ignore any other multiples, mainly because you can't calculate them when the EBITDA and EPS estimates are negative out into the next few years for most of these companies. Also, when we look at public companies, we have to take into consideration that equity markets are usually forward-looking in nature. Equity traders are looking at what's projected a year out or even further sometimes. So with that in mind, I'm keenly focused on the 2021 revenue estimates and multiples for these companies, as are the equity analysts and traders in the market as well. 2020 revenue multiples are cool, and they're a sanity check right now, They're really a vanity metric. Honestly, they are headline grabbing vanity metrics because they're really high. But the real analysis to do right now is on 2021 and 2022 multiples. If I were a founder of a startup in this space, I'd be keenly focused on the enterprise value to 2021 sales multiples, as they are about a year out from today, January 2021. What I mean by that is they are based on revenue to be earned over the next year, the next 12 months, which is similar enough to an annual recurring revenue or an ARR, that we can compare those forward multiples to ARR multiples in the startup market as a benchmark. So let's dig into the public comps. Let's start with some benchmarking first. When you look at comps, you should always keep in mind how your growth and margin profile compares to the company you're comping to. Among the digital healthcare services comps, the average revenue growth rate from 2020 to 2021 is expected to be about 32.1% year over year revenue growth. And that's going to go to 31% in 2022. These same companies are expected to have an average EBITDA margin of 5% in 2021, going to 10.7% in 2022, doubling profitability in 1 year, which makes sense considering these are still very early stage, newly public, for the most part, young companies. And now the part everyone's been waiting for, the valuation multiples. As I mentioned before, I'm focused on the enterprise value to 1 year forward revenue multiples so I can compare those on an apples to apples basis to valuation on an ARR multiple basis with early stage companies. The digital healthcare services companies currently trade at an average enterprise value to 2021 sales multiple of 10.4x and an enterprise value to 2022 sales multiple of 8.1x. As a VC, I often look at the multiple of ARR, but as a sanity check, I always find it helpful to look at the 2-year forward multiples as a function of projected revenue. With startups, you always have to discount estimates, but a conservative haircut to 2-year forward revenue multiplied by an 8.1x 2-year forward multiple should give me a data point that is helpful. The disparity in valuation implied by that number and the valuation implied by the current ARR multiplied by the front year multiple of 10.4x usually gives me a good starting point to figure out what's going on. Is this fairly priced? Is there something going on in this business I'm not picking up on? The quick back of the envelope calculation here usually drives my initial diligence efforts and the first questions I ask a founder. And those questions are likely not even going to be finance questions, but rather operational questions that will help me triangulate to some sense of fairness when it comes to the proposed valuation. But that's enough about the public comps in Corporate Finance 101. Let's talk about what's going on in the private markets. I'm going to share with you 9 key takeaways from the mental health startup market going into 2021 based on my experience in the space last year. Talking to you about private market valuation trends is tricky because, as everyone in the startup world knows, it's really poor form to make private market valuation data public unless founders give you express consent to do so. And I've met very few founders who are okay with that. So unless a number has been printed in the press as a quote from a company, I'm going to avoid any company-specific information and talk to you about what I'm seeing in the market generally. In 2020, I looked at more than 1,000 mental health startups and closely evaluated over 500 rounds for investment purposes. Then, at the end of that year, I surveyed 150 mental health startup investors and asked them for their opinions on what a fair valuation as a multiple of ARR is. Here's some of my key takeaways from my efforts and that survey. Number 1, the mental health startup market is coming of age quickly, very quickly. Investment in this space has skyrocketed in 2020. More than $2 billion has been invested into startups in this space during that year. Number 2, seed stage valuations are very high, and in some instances, too high. It's common to see pre-product, pre-MVP decks from startup founders that are raising on $10 to $15 million valuations, which is pretty frothy in my opinion. Based on my limited 6 years of startup investing, those valuations should probably be in the $5 to $10 million range. But nobody asked me, so I'm here sharing my thoughts into a microphone in my mom's basement. Number 3, in later stage deals, valuations are even more lofty. In Series B and later rounds, it's become very common to see $50 million equity raises getting done on a $500 to $600 million valuation with companies that have about $20 million in annual recurring revenue. That's up to 30x valuation multiple on a projected annual revenue based on a tiny snapshot of company performance. 30x is ridiculous in the public markets, but could be somewhat realistic in the private market. But still a stretch in my opinion. When looking back at the public market comps, the single highest 2021 revenue multiple in the market right now is Oak Street Health with a 19.6x enterprise value to 2021 sales multiple. At one point, Teladoc was trading above 20x forward revenue, and we saw Livongo right before the acquisition trade above 30x. Number 4, we surveyed 150 mental health startup investors at the end of 2020 to get their opinion on what's fair by way of valuation. We asked those investors, what is a fair valuation multiple for a mental health startup as a multiple of ARR? We gave those investors 6 options of ranges of multiples to choose from. Those options were 1 to 4x, 5 to 8x, 9 to 12x, 13 to 16x, 17 to 20x, and 21x or above. nearly 60% of the investors selected either 9 to 12x or 13 to 16x. My personal sense is that 10 to 15x seems about fair on an ARR basis right now, so I'm not surprised. I was surprised, however, to see that 10% of investors said 17 to 20 was fair, and 8.7% of the investors said 21 or higher was a fair multiple. That's nearly 1 in 5 investors who've put real work into this space that we've worked with on a personal basis that are saying multiples approaching or are higher than 20x are reasonable in this space. And to be honest with you, I'd pay that for the right company. I'm going to be really vulnerable with you and tell you, just honestly, one deal I did this year, I paid way above that. Off the charts even compared to about what we're talking about here. Was it smart? Will it work out? I don't know. I believe so, but I could be wrong. I certainly don't want to make a habit of paying more than 20x ARR, but it's going to happen in a space that's as hot as this. I know I'm being super cautious about high valuation multiples, and that's the investor in me, for better or for worse. But with that said, some of those companies that have raised these high price valuation rounds are still going to make incredible returns for their investors. I'm not saying those were bad rounds or those investors weren't smart. I'm saying that those 30x or higher valuations are exceptions to the rule, and the rule is set by efficient market theory. If you are an investor or a founder involved in one of those rounds right now, congratulations, you are an outlier, and I hope you keep doing amazing things, and you know who you are. Number 5, and this is probably my biggest soapbox of the 9 key takeaways. There's a lot of dumb money rushing into this space chasing hot deals. There's really 2 levels of absurdity that I want to talk about here. One is the general mental health startup space. For sure, there's a lot of money chasing good deals as stigma decreases and more founders build in the space and investors realize the significant supply-demand imbalance in the space compared to the sheer size of the problem we're trying to solve. A lot of that money is so hungry to deploy in this space that it's falling victim to the buzzword-happy founders who can tell a good story, which is leading to situations where some investors are chasing founders at high valuations into deals where the investors have no chance to ever get their money back. But that's not unique to our market. That's just how it works in startup land. However, in our market, those of us who spend all of our time here do have a sense of responsibility to make sure that bad solutions that could hurt people do not get funded as we work in a space where people's lives are on the line and their wellness is at hand. I want to call out the psychedelic space specifically. When we polled those 150 investors about what sectors they found most appealing, psychedelics was the clear winner. Hands down, far and away, no questions. Psychedelic investments seem to be the most appealing to the investors we polled. This makes sense as there's been a lot of hype and there's a lot of hopes and expectations, and we've already seen some public market exits at huge valuations with companies like Compass Pathways. For those of you that are not as familiar, Compass Pathways went public in September 2020 on the NASDAQ in the United States. Its initial stock price was $17 a share, which implied a valuation just over $500 million, quickly traded up to nearly $40 on the first day. Since then, the stock has traded as high as $60 or slightly over and is currently trading at about $45 a share. Regardless of how you slice it, the company is a unicorn and investors want to be a part of the next Compass. For those looking into the space, please tread with caution. There are a ton of dangerous companies out there raising cannabis-style money going public with thinly traded, low-volume stocks via RTOs and other methods in Canadian markets. We've made money in a company that did this, so I'm not saying it's all bad. That company was Field Trip Health, but my official position right now is to be overly cautious of companies who can't or won't raise funds traditionally, whether it be early stage or late stage, or list with greater trading volume on a more traditional exchange like what Compass did and like what Atai is about to do. It's very hard to get your investment back out of these companies when they are so thinly traded. In that same survey that we conducted, though, while psychedelics certainly were the most popular of the verticals, psychedelics also received a lot of votes for least appealing among our investors. It was really interesting to me how many people really dislike the idea of investing in psychedelics, and I suspect we'll learn more about why they feel that way over the course of the next year. You may be wondering what the other hottest sectors are per our survey. That's a topic for another day, but you can find all of the survey results in our January 2021 blog post titled Mental Health Investor Sentiment Survey, Extreme Optimism Going Into 2021, which is going to be linked in the show notes. Takeaway number 6, it's getting harder to invest intelligently in the mental health space. Like I said before, buzzwords and hype as well as quick wins to early investors in the space have made it significantly more challenging to invest intelligently in this space in 2021. You have to be selective about the specific problem sets and solutions, as well as the near and long-term market opportunities you're investing in. There are countless permutations and combinations to choose from, and knowing what to avoid is really the key. Lots of things look shiny on the surface, but all that glimmers is definitely not gold in this space right now. You have to be smart about the incentive alignment of all parties involved in a mental health care solution, from the patients to the users to providers, payers, government, schools, and many others. Takeaway number 7, VCs are late to the space, and a lot of them are rushing in due to market sentiment and LP pressure around the buzzwords we mentioned before. A lot of the money rushing into the space comes from people who have spent very little time understanding the landscape, the dynamics between the players in the space, and or healthcare broadly. This isn't SaaS. This isn't consumer tech. You can't just hit winners in this space because you follow General Catalyst or Founders Fund or Kleiner Perkins blindly into deals. There will be a time in the space when that happens, but we aren't there yet because the tier one funds haven't gotten as smart on the space yet as they need to. I say this from firsthand experience as a passive investor in deals led by some of those funds, where the guidance I'm seeing those bigger investors, quote unquote, give to the company is harmful, to say the least. Takeaway number 8, 2020 was the year of capital inflow. 2021 needs to be the year of building and executing. Let's see what happens with these companies that raise huge rounds at massive valuations in 2020. Do they execute and grow into those valuations, or do they stumble, setting our space back and resetting expectations for the future? Only time will tell. And finally, my 9th takeaway, I see a lot of consolidation on the horizon. The mental health space is super fragmented, and not because of the volume of startups, but the space has always been very fragmented. It's a fragmented landscape of small clinics, small providers, mom and pop shops, individual clinicians, etc. And payers aren't excited about working with thousands of providers. They really want a hub and spoke system, so to speak, to emerge. The startups that are headed for the biggest outcomes in this space, in my opinion, are platform plays that solve the fragmentation of care delivery problem for or adjacent to the payers who really do feel that as a huge pain point. And that's it. Those are our thoughts going into the new year. So I want to say thank you very much for being here and for listening. I want to say thank you for all of your support during 2020. To our listeners, we are very grateful to have you here. If you liked our content, if you like what we're doing, please share us with a friend or leave a review on your podcast platform of choice. For the mental health startup founders listening, we want to make sure you are aware of the What If Fellowship program. This is an accelerator for mental health startups designed to help facilitate increased company building within the mental health space. The goal of the program is to help mental health startup founders accelerate the process of going from an idea to a plan to execution and funding. You can learn more about that on the fellowship tab of the What If Ventures website or through a link in the show notes here. With that said, please don't hesitate to reach out to us with any questions or comments. You can reach out to us on Twitter at StigmaCast, on Instagram at StigmaPodcast. You can email us info@stigmapodcast.com, and you can find us on our website, stigmapodcast.com. Thank you again for being here. And until next time, stay safe, be well, and thank you for your support.